Look, if you're sitting there surprised that we're watching real estate implode in 2026, you haven't been paying attention. And frankly, that's on you, because this wasn't some act of God. This wasn't a black swan. This was the most telegraphed disaster in modern financial history, and I've been screaming about it for years. The problem is nobody wants to hear the truth when the music's playing. Everybody wants to dance. Everybody wants to believe that somehow, magically, the laws of economics have been suspended, that supply and demand don't matter anymore, that you can print unlimited money, drop interest rates to zero, let every idiot with a pulse borrow millions, and somehow it all ends well. It doesn't. It never does. And here we are. I've been doing this for over 50 years. I've seen the savings and loan crisis. I've seen the dot-com bubble. I've seen the great financial crisis. I've seen commercial real estate get crushed, residential get annihilated, entire markets go to zero. And every single time, right before the collapse, you hear the same stupid phrase, "This time is different." Let me tell you something. It's never different. The variables change. The narrative changes. The asset class might change. But the fundamentals are always the same. When you flood the market with cheap capital, people do dumb things. They overpay. They overbuild. They underwrite fantasy cash flows. And when reality shows up, the whole thing comes apart. So what happened? Let's be brutally honest. Coming out of the pandemic, central banks lost their minds. They dropped rates to nothing. They bought everything. Governments spent like drunken sailors. And all that liquidity had to go somewhere. It went into assets, stocks, crypto, and real estate. Suddenly, everybody's a real estate mogul. Private equities buying single-family homes by the thousands. Office buildings in secondary markets are trading at cap rates that make no sense. Apartment buildings are getting bid up like they're irreplaceable works of art. And the whole time I'm sitting there thinking, have you people forgotten how to do math? Because here's what matters in real estate: cash flow, replacement cost, supply and demand. That's it. You can tell me all the stories you want about demographic trends, about millennial formation, about work from home creating demand for more space. I don't care. Show me the numbers, show me the rent growth, show me the occupancy, show me that the building generates more cash than it costs to own and operate, and show me that you can't just build a new one across the street for less than you're paying. If you can't show me those things, you don't have an investment, you have a speculation, and speculation works great until it doesn't. What did we see starting in 2021, 2022? We saw cap rates compress to levels that only made sense if you assumed interest rates would stay at zero forever and rents would grow at 5, 6, 7% a year indefinitely. That's insane. That's not investing, that's prayer. And the people making those bets, they weren't using their own money. They were using leverage, cheap, easy, everywhere leverage. So you had buyers paying peak prices with maximum debt at the lowest cap rates in history, and they were all convinced they were geniuses. I'm telling you, I watched this and I thought, this is 2007 all over again. Different asset class, same stupidity. And here's the thing that really drove me crazy. The office market. I've been in the office business my whole career. I know how it works. And I knew the second the pandemic hit and companies realized they could function with people at home, that office demand was going to get crushed. Not a little bit, a lot, permanently. Because once you let that genie out of the bottle, once you prove that you don't need everyone in a building 5 days a week, the economics of office space change forever. Suddenly you need way less square footage per employee. Suddenly sublease space floods the market. Suddenly new construction that was already in the pipeline becomes obsolete before it's even finished. And what did the market do? It kept building, it kept financing, it kept pretending that occupancy would come back to 2019 levels. It won't. It's not coming back. And every dollar invested based on that assumption is dead money. I'll tell you what I was saying in 2022, 2023. I was saying if you own office buildings in second and third tier markets, you're in trouble. If you're levered, you're in big trouble. If your leases are rolling in the next few years and you're underwriting renewal rates at previous levels, you're delusional. The demand isn't there, the supply is massive, and the debt you took out at 3% is rolling over at 7, 8%. Your building doesn't cash flow anymore. Your equity is gone. You're going to hand the keys back to the lender. And that's exactly what's happening now in 2026. We're seeing defaults everywhere. We're seeing lenders taking back properties worth half what the loan balance is. We're seeing forced sales. And the people who bought at the top, they're getting annihilated. But it's not just office. Multifamily got stupid too. You had these massive apartment complexes getting built in Sunbelt markets, financed with floating rate debt, underwritten with aggressive rent growth assumptions. And for a while it worked because people were moving, because rates were low, because rents were actually going up. But then what happened? Supply caught up. Developers saw the returns and they all rushed in. Suddenly you've got 5,000 new units hitting a market that can only absorb 2,000. Occupancy drops, rents flatten, and your debt service just went up 50% because rates reset. Now you're burning cash every month, you're trying to refinance, and the lender's saying, sorry, the property doesn't appraise anymore, we need you to pay down the loan. You don't have the cash, you default. Another one bites the dust. And retail, don't even get me started on retail. I got out of most retail years ago because I saw the writing on the wall. E-commerce isn't a trend, it's a structural shift. Every year, more spending goes online. Every year, you need less physical square footage. And yet, people kept building strip centers, kept buying malls, kept believing that somehow their location was special, that their tenants were safe. They weren't. The anchor tenants are dying. The mom and pop tenants can't pay rent. The traffic is gone. And the valuations are in free fall. I've been saying for a decade, if you don't own the absolute best real estate in the best locations with the best credit tenants, you're going to get crushed. And that's exactly what's happening. So why did people ignore all of this? Because they wanted to believe. Because in a low rate environment, you convince yourself that yield is scarce and you have to take risk to get return. Because everyone else is doing it, so it must be okay. Because the investment banks are pitching it. Because the private equity funds are raising billions to do it. Because CNBC has some talking head on saying real estate is a great inflation hedge. It's all noise, it's all narrative, and narrative doesn't pay the mortgage. Here's what I learned a long time ago. The best time to make money in real estate is when everyone else is terrified, when there's blood in the streets, when sellers are desperate, when banks are dumping assets, when nobody wants to touch anything. That's when you find replacement cost opportunities. That's when you buy buildings for 60 cents on the dollar. That's when you lock in long-term cash flow at prices that actually make sense. But you can't do that when the market's at the top. You can't do that when cap rates are compressed and everyone's fighting over the same deals. You have to have patience, you have to have liquidity, and you have to have the discipline to sit on your hands when the deals don't make sense. I spent the last few years selling. I sold properties. I returned capital. I told investors, we're not buying here. The risk reward is terrible. And they got mad. They said, you're leaving money on the table. You're too conservative. You're missing the opportunity. And I said, fine, go chase it. Go lever up. Go pay peak prices. We'll see who's right in a few years. Well, here we are. And I'm sitting on cash. And they're sitting on properties they can't refinance in equity that's evaporated. You want to know what the real crime is? The real crime is that this didn't have to happen. If people had just done basic underwriting, if they had stress tested their assumptions, if they had asked what happens if rates go up, what happens if demand softens, what happens if we're wrong, they would have walked away from 90% of the deals they did, but they didn't ask those questions. They didn't want to ask those questions because asking those questions meant not doing the deal. And not doing the deal meant not earning fees, not putting capital to work, not looking busy. So they did the deals anyway, and now they're paying the price. And let's talk about the lenders because they're just as guilty. Banks, debt funds, life insurance companies, they all underwrote loans based on appraisals that assumed the market would keep going up. They lent at loan-to-value ratios that left no margin for error. They didn't require reserves. They didn't stress test the cash flow. They just wanted to deploy capital and earn a spread. And now they're sitting on portfolios full of non-performing loans. They're going to take massive write-downs. Some of them are going to fail, and taxpayers or depositors are going to eat the losses. It's the same story every cycle. Lenders get greedy on the way up, then they panic on the way down, and they make everything worse. But here's what really gets me. The institutional investors, the pension funds, the endowments, the sovereign wealth funds, these are supposed to be the smart money. These are the people with 100-year time horizons, with armies of analysts, with access to the best information. And what did they do? They piled into real estate at exactly the wrong time. They allocated billions to private equity real estate funds that were raising record amounts of capital in 2021, 2022. They committed to vintage years that are going to be disasters. And why? Because they were chasing returns, because their actuarial assumptions require them to earn 7, 8% a year, and bonds were yielding nothing, so they reached. They took on risk they didn't understand, in markets they didn't understand, with managers who were incentivized to deploy capital whether it made sense or not. And now those pension funds are sitting on portfolios that are marked at fantasy values because nobody wants to admit what things are really worth. They're praying that the market comes back before they have to show the real losses. They're hoping that somehow they can hold long enough to recover. But the math doesn't work. If you bought an office building in 2021 at a 4 cap with cheap debt, and now that building is worth 40% less, and your debt costs twice as much, you're not recovering, you're done. The only question is when you admit it. I want to talk about something else that's been bothering me. The consultants, the advisors, the people who are supposed to help investors make smart decisions, where were they? They were cheerleading. They were producing reports showing that real estate was fairly valued. They were recommending allocations based on historical return assumptions that had no basis in current reality. They were getting paid fees to tell people what they wanted to hear. And now that it's all blowing up, where are they? They're saying, well, nobody could have seen this coming. It was unprecedented. The market changed. That's garbage. Plenty of people saw it coming. I saw it coming. Anyone who was paying attention to fundamentals saw it coming. But you don't get hired to tell people not to invest. You get hired to help them invest. So that's what the consultants did. Let me tell you about replacement cost, because this is fundamental and people forget it. If I can build a brand new building for less than I can buy your existing building, why would I buy yours? I wouldn't. I'd build new. And that puts a ceiling on values. But when construction costs are high and capital is cheap, people convince themselves that the existing buildings are worth more because you can't replace them at that price. Okay, fine. But what happens when demand drops? What happens when half the buildings are empty? Suddenly the fact that you can't build new doesn't matter because nobody needs new. You've got too much supply already. And now your irreplaceable building isn't irreplaceable. It's just expensive and empty. That's where we are now. Construction costs are still elevated. Labor costs are high. Materials cost more, but demand has collapsed. So we're stuck with a bunch of buildings that cost a fortune to build and nobody wants to occupy. The replacement cost argument works when you have scarcity. When you have excess, it's meaningless, and we have massive excess in most markets. I also want to talk about what's happening with the regional banks, because this is critical. Regional banks are the primary lenders for commercial real estate in this country. They hold trillions in CRE loans. And a lot of those loans are underwater. A lot of those loans are going to default. We already saw some regional bank failures in 2023. We're seeing more stress now in 2026. And when regional banks pull back from lending, the entire market freezes because the big national banks aren't going to step in. They don't want the exposure. The debt funds are pulling back too. So you've got this massive wall of debt that needs to be refinanced over the next few years. And there's nobody to refinance it Borrowers are stuck. Buildings are going back to lenders. Lenders are becoming reluctant landlords, and the whole system is clogged up. This is deflationary for real estate. When you can't get financing, you can't buy. When you can't buy, prices fall. When prices fall, more loans go underwater. When more loans go underwater, more lenders pull back. It's a vicious cycle, and we're in it. The only way out is for prices to fall far enough that cash buyers step in, that equity returns to the deals, that fundamentals work again. But that takes time and it takes pain. Now let me talk about geography, because not all markets are created equal. The Sun Belt markets that everyone was so excited about, the ones that had all the population growth and job growth, those markets overbuilt like crazy. Phoenix, Austin, Nashville, Charlotte, Tampa, they all added supply far in excess of what demand could absorb, and now they're paying the price. Rents are falling, vacancies are rising, the migration trends are slowing, and the investors who bought based on the assumption that growth would continue forever are getting killed. Meanwhile, some of the older, slower growth markets that people wrote off, places where supply was constrained, where you had real barriers to entry, where the fundamentals were actually better than people thought, those markets are holding up better. Not great, nothing's great in this environment, but relatively better. And that's the lesson. Don't chase growth, chase fundamentals, because growth can disappear overnight. Fundamentals are more durable. I'm also seeing something interesting in the single-family rental space. This was the hot trade for a while. Institutional investors buying up homes, renting them out, creating portfolios, securitizing them, and it worked for a while. But now we're seeing some of those portfolios struggle because they overpaid, because they underwrote rent growth that didn't materialize, because maintenance costs are higher than they expected, because managing thousands of scattered single-family homes is operationally intensive and expensive. Some of these investors are going to exit, they're going to sell, and that's going to put downward pressure on home prices, which are already softening because mortgage rates are high and affordability is terrible. So you've got commercial real estate crashing, you've got residential under pressure, you've got lenders pulling back, you've got defaults rising, and the feedback loops are all negative. This is a multi-year workout. This isn't something that gets fixed by the Fed cutting rates 50 basis points. The structural problems are too big. The overcapacity is too big. The debt burden is too big. Now, I promised you that I'd tell you where I see the next major distortion forming, and I'm going to deliver, because while everyone's focused on the real estate crash, while they're panicking about office and apartments and retail, they're missing something huge. They're missing what's happening in infrastructure. And I'm not talking about roads and bridges, though God knows we need those. I'm talking about the infrastructure of the digital economy, data centers, cell towers, fiber networks, logistics facilities, the stuff that makes modern life possible. Here's what's happening. Demand for these assets is exploding. AI needs massive computing power. E-commerce needs massive distribution networks. 5G needs massive connectivity. And the supply of quality infrastructure assets is limited. You can't just build a data center anywhere. You need power, you need connectivity, you need security, you need proximity to demand. Same with logistics. You can't just throw up a warehouse in the middle of nowhere. You need to be near transportation hubs. You need modern design. You need the right labor market. These assets have real barriers to entry. They have real replacement cost dynamics, and they generate real cash flow with long-term contracts, often with inflation escalators, often with investment-grade tenants. But here's the distortion, because money got so easy because everyone's chasing yield. These infrastructure assets have gotten bid up to prices that don't make sense either. You've got private equity funds paying 10, 12, 15 times EBITDA for data centers. You've got REITs buying logistics portfolios at cap rates in the threes. You've got investors treating these assets like bonds, like they're low-risk, steady-state cash flows, and they're not. Technology changes, tenants go bankrupt, competition emerges, And if you overpaid, if you leveraged it, if you didn't leave room for things to go wrong, you're going to get hurt here too. So my point is this: there is opportunity in infrastructure. There is real long-term value in owning the critical assets that power the economy, but you can't pay stupid prices. You can't assume that just because something is mission critical, it's immune to economic cycles. You have to underwrite it like any other investment. You have to understand replacement cost. You have to understand the competitive dynamics. You have to make sure the cash flow supports the price you're paying. And if it doesn't, you walk. Here's my call to action for you. Stop chasing trends. Stop listening to narratives. Stop believing that this time is different. Demand to see the numbers. Demand free cash flow. Demand assets priced below replacement costs. Demand margin of safety. Look for value where everyone else sees trash. Be patient, be disciplined, and be willing to sit on cash when there's nothing to buy. If you want to think like an owner instead of a speculator, if you want to survive the next cycle and the one after that, hit subscribe, hit like, because I'm going to keep telling you the truth, even when it's uncomfortable. Drop your investment theses in the comments. Tell me where you think I'm wrong. Tell me what you're seeing in your markets. I'll try to answer honestly. And if the answer is that you made a mistake, I'll tell you that too, because that's how you learn. That's how you get better. That's how you build real wealth over time, not by getting lucky in a bubble, but by understanding fundamentals, respecting risk, and having the guts to be contrarian when everyone else is following the herd.